Brooker, take it off.
Okay, so we have one of our favorite guests and a much loved guest from all of our listeners, Dieter Schärer, joining us, who is our AKA Swiss finance guy. That's your new nickname, Dieter, mate. And
Thanks.
we wanted to give you guys something that was a bit more practical than our last discussion, which was a bit of a whirlwind over all things finance and investment. So we come up with a collection of different questions for Dieter. And basically the theme of this is, what do we need to do to set ourselves up for long-term financial success? One of the biggest questions that we got, so Dieter, we'll just run straight away. Once we start saving money, where should we be putting it?
All right. Well, first of all, thanks for inviting me again to the show. You guys look great. Your hair is growing, mine is falling out, but I think that's a matter of life. Well, going back to your question, and I agree with you. In a way, we did it the reverse way. You know, investing and finances comes after what we are talking about today. And I think again, thanks for inviting me. And I think this has a lot to do not only with financial planning or saving money. It has a lot to do also with life planning. And I think you have to ask your question first, what are you saving for? Are you saving to buy yourself a car? Are you saving to afford something big in life? Or are you saving to put money aside? And I think one of the critical things is, first of all, can you afford to save? Or do you need the money? So can you afford to save? And if you can answer that question with yes, obviously you need to have a certain time horizon in mind. Because if you need your money 2 months down the road, that's not really saving. If you need it 2 years down the road, it kind of starts right there about saving. But in general, I would say you need to define for yourself, what can you put aside, what you call your savings, and what is your time horizon. And then you can start considering saving in a structural way.
Right. And so would you say, I mean, of course, it's dependent on each different person, but is there a certain percentage that you would recommend, even someone that's, you know, bare bones, they're just about paying the bills every month? Is there a certain amount that you would always recommend that they should try and put away as a sort of an emergency fund or something like that? Is that what you would recommend? Because I mean, you hear some advice, always save 10% for a rainy day. But of course, some people can't do it. But would you recommend that people really try and organize their expenditure so that they could save at least some percentage?
Well, you can work around percentages, but I guess in many cases it's not about percentages. It's more about what are you trying to achieve? What is your goal? I don't want to bore the audience by telling you want to be saving for your old age 30, 40 years down the road. But going back to your question on saving on a rainy day, you got to be clear and be aware of what could be the rainy day. So is it the car breaking down? Is it a huge doctor's bill coming in? So what are you saving for? So I guess it's not about percentages. It's more about the worst case scenario. I mean, what could happen to you, which really could bring you into the negative, into a difficult situation on your balance of payments, if I may put it that way. And I think a very important start for saving money, and again, not using percentages, is really creating your budget. You need to know where your money is going. You need to know where you spend your money, whether it's just daily stuff like grocery or insurance premium, or whether you have other commitments outstanding. All of that, you gotta do your own personal budget. And I think this is very important because we all are different. We're all individuals, and every life cycle is different. And you just need to do status quo. Where do I stand now? Analysis, and then take it from there.
So So how would you break? Obviously, everyone's goals are different, right? But
Right.
how would you break it down? Like, how much money would you say someone needs to save? Like, hey, you should have $10,000 saved for car issues. You should have $50,000 saved for health insurance. You should have X amount saved for retirement. How would you break it down? I mean, obviously, where you live, how you live. Switzerland's a little bit different than Texas, than Missouri, than New Jersey, right? So what would you recommend with something like that?
Well, there are a number of rule of thumbs, if I can put it that way, but really it comes down to the individual's situation. In many cases, I would assume, correct me if I'm wrong, but I would assume that people are having a certain income and then they just spend what is necessary, and whatever is left is a residual. It's not about planning, it's just is left, right? But there's a number of thoughts I can throw at you. One important one is how much you spend on housing. And there's a rule of thumb which says you shouldn't spend more than 1/3 on housing, whether this is the mortgage rate together with the maintenance for your own house, or whether it is the rent plus side costs and gas bills whatsoever. You shouldn't be spending more than 1/3 on housing. Obviously, then it depends what kind of a tax rate comes in, which is going to be charged against your income. And obviously, if I look at myself, for example, what I'm spending or my family is spending on communication, from TV to cell phones to internet and downloads and whatever, you name it, there's huge amounts piling up. And I think in America, in the US in particular, certain extent in the UK as well, is if you are a father of children who go to school, you pay a huge school bill for sending your children to school. So everybody is different, but there are some mechanics, and it starts with knowing where your money is going. That is the most important. And in many cases, as I said, the saving is not a clear intention. It's more of a residual, because you cannot save money by eating less or by not paying your insurance premium, right?
So 1/3 of what? 1/3 of your paycheck? 1/3 of your savings? What 1/3 are you talking about in regards to
1/3 of your paycheck? 1/3 of your paycheck, yeah. So if you make $10,000 a month, you shouldn't be paying more than $3,300 for housing.
So that includes mortgage, tax, anything associated with the housing, like any kind of residuals that you put away for insurance purposes or anything like that. Like even fixing up the house, all that.
Yeah, that should cover that. Yes, absolutely. It should be like a maintenance fund. I mean, you pay a certain amount for the mortgage rate. You pay your gas bill. You pay your heating oil, whatever is needed. And obviously, I guess you need to put aside an amount on a monthly basis or whatever, like in a fund where you can draw from when you need to do refurbishments, for example.
And keeping on this sort of theme of housing, one of the things that me and Mike get asked a lot is, especially now we're at the age where everyone's having children and starting to create their families, they want ownership of a house. And so many people ask, when am I able to buy a house? What would be your recommendations? I mean, how much, especially now, because there's so much confusing stuff about down payments and mortgages and stuff like that. What's your general rule of thumb?
It's an easy one, because it's again going down to you should be spending more than 1/3 of your income on your housing, and then you start with that, and then you see whether you can afford the house. I think it all has to do with your affordability. And I'm very honest. People, first-time house buyers, I guess they have to lean out of the window a little bit. Maybe you want to tweak that 1/3 slightly at the beginning, but you want to go back into that 1/3 very quickly. Quickly saying, let's say, within the next 3 or 5 years, you should be down within that bracket of 1/3. And again, going back also to Mike's question, that includes all what comes with it. You know, the refurbishment fund, where you need to you fix your tiles on your roof, or the heating breaks down, whatever. You need to have some money set aside for these cases. Important also when you talk about tax, I guess I was referring to income tax. I don't know, because the housing tax might be very different to many different locations, even within the US, let alone Europe or Switzerland. But the 1/3 is not covering income taxes, right? That's only the taxes which might come up with owning a house in, I don't know, in Missouri, or I don't know. Okay. What they would be charging for that.
So to be clear, if you're making $100,000 a year, that's what, $8,000 a month. 8,000 divided by 3, that's $2,666 per month. But if you're making $100,000 a year, let's say you're getting taxed, I don't know, 40%, right? So is it on the taxed money, or is it on the initial pre-taxed money?
I would have thought it's on the initial pre-tax money. Absolutely.
Okay. Yeah. So all in, we want to put on the pre-taxed money. Then the $2,600 is an appropriate amount that someone could be paying on their taxes, mortgage, and then whatever savings they're having in with the house. And that also includes heat, electric, Wi-Fi, all that stuff.
Yeah, absolutely. Because the 2/3, which are going to be left to you, as you said, you're going to be paying the taxes and you're going to be paying for your life. So the 2/3, you need that. You're definitely going to need that, right?
Okay.
Depending what kind of a lifestyle you live, of course. Yeah. But you will be needing the 2/3. And now, again, this is, Mike, clearly this is a rule of thumb. You know, you can say you can use 30% or 35% or 37%, but clearly you shouldn't be using 50. That's my message, right? You shouldn't be spending half of your income on housing. Then the affordability question, I think you have to answer with no, I'm not able to afford that house.
Yeah. So for our listeners, just so you guys are clear, those of you that are making $60,000 a year, that's like $1,600 a month that you should be spending on living on your house, between all the things that we listed. 1,600. I'll tell you what, Dieter, $1,600 a month will get you a 1-bedroom apartment where I'm from. For people making $60,000 a year, that's nuts. So that's why majority of people probably shouldn't be buying a house then, because they just can't afford to do it. They'll put them in the hole too much. In that case, would you recommend that someone like that is better off renting rather than buying?
It's a tricky question, Mike, because buying these days is relatively cheap on the back of cheap financing. Mm-hmm. So if you get a cheap financing, the 1/3 rule we were talking about in length now, you know, it looks like you can afford it. What you have to make sure is that you are fixing that financing right for a relatively long term, so you know what these mortgage costs are for you. So it might be cheaper, depending on how much you spend on it. It might be cheaper to buy an apartment or a house because financing is so cheap. I'm not aware at all about rents in the US in major cities, but I could imagine could be expensive. So, yeah. But housing in general in big places, in the big cities in the US, I guess is pretty expensive.
Okay. All right. Brooker, let's go on to the next part.
We mentioned general general rules, Dieter, and one of the questions that we put into our email thread was general do's and don'ts. Is there another one that springs to mind straight away that we could sort of segue into? Because I know that we covered some of our questions with these general rules.
Well, the do's clearly, it all starts with the budget. You need to know where your money is going. And to be very straightforward here, I mean, I was trying to teach my two teenage children or young adults looking at their budget, and one is doing it, the other one isn't. But it's a very, very useful exercise just to be aware where your money is going. Because if you need to save money, if you have that ambition and that goal to save money, you then see where the money is going and where maybe you are overspending. So this is exactly where you want to start cutting down and putting money aside. So I think knowing where you are, the budget is very important. And then you can start adjusting your spending habits in order to be able to save. And when you save, I think you need to define for yourself a time horizon, 5, 10 years or old age, whatever. And you need to define yourself what kind of a risk appetite you have when you start investing that money. So that all comes together. And all of that is massively influenced by your living situation. If you're a single and you just are responsible for yourself, I mean, you can do whatever you want with your money, right? If you are starting a new job or starting a new business, you have new commitments, you have an income which is not coming in as a steady flow, and because it's a bit up and down, you want to be more careful with how you spend your money. And the most important, if you're a father of a family with children, your responsibility is even bigger, because you're not only taking care of yourself, but you are taking care of other people, and you're taking care of children, right? And this has to have an impact on how you structure your spending habits and how you are budgeting your life. Don't get me wrong here. I'm not a life coach, whatever, but I'm just cautious with finances, and usually from where I come from, where I grew up, you buy what you can afford, and this is also a rule which helps you not to get trapped by debt and things like that in your life cycle.
So then that is a great point into then leasing, because especially amongst young people nowadays, they're all into sort of leasing cars that they probably couldn't afford to buy outright. Yeah. You mentioned it's kind of a philosophical question. What do you mean by that?
Well, philosophical in the sense that I think it's a cultural difference between Central Europeans like myself and maybe Anglo-Saxon countries. When you grow up there, it's the most normal thing you do. You take credit card debt, you take other debt in order to buy a car. Where I grew up, I think we're a bit more conservative in the spending habit, and the leverage or in your private balance sheet, so to say, sounds complicated. It's simple. You spend more than what you make, right? I think that's in the Anglo-Saxon world, that's more normal than where I grew up. I think, and I'm not judging here, not at all. I think that's just the way it is. And the philosophical side behind it is what I said before. For my take, I spend money, or I buy something when I have the money, and otherwise I wait until I can afford it. But that's maybe for a lot of ambitious youngsters between 18 and 28 and 30, that's too long for them to wait. And they live now, they live today, and they want to enjoy life, and they spend money which they don't have. But I think it's just a different way of life.
Yeah, I can't tell you how many people I know that don't make what I make and drive cars 2-3 times as expensive as the ones I drive. These people are fucking nuts. But one,
but see, maybe if I may just quick kick in here, it's also a question what is important for you. You know, there's one person who spends $100 on a bottle of wine, and another person says you're nuts. You know, I can get a bottle of wine for $8 or $10. So you know, for other people, it might be more important to show up with a nice car, but they're saving left, right, and center to afford that. So that's why I say I don't want to be judgmental. People have different ambitions in life and different priorities, but at the end of the day, it should balance so you can afford a decent living over the life cycle.
Now, one thing that someone had said to me, which I thought was pretty interesting, when I was discussing buying a house, and I said, well, I don't want to afford X, Y, and Z because I make this right now. And I want to make sure that even though like I can afford, you know, a price of house, you know, the house that's this expensive, I still, even though I can afford this, I still want to be here. And the person said to me, but you're nuts. And I said, why? He said, well, because you're not even close to your peak earning potential. You're not even close to it. With the path that I see you on, he says, you can afford this house, but you can also afford this house, no problem. But to me, there's no guarantee, right? Like, yeah, I'm an up and comer, so to speak, in the finance world or finance world, but from my ability to earn, I'm scratching the surface of what I can do in the future. And sure, maybe it seems certain to others, but to me, that's not a guarantee. So how do you feel about someone saying, well, why would you buy this house, waste your time there just because you're going to end up buying this house anyway? Would you ever suggest to someone that you see is performing well and on a good track to perform, like, yeah, it's okay for you to buy that, even though it's not currently 1/3 of what you make? It might be half, but in 2 or 3 years, it'll end up being that third.
To be honest, I think that you are the best to judge yourself. And if you are cautious for your prospective earnings path going up, I think you're just going to be, you have to feel comfortable in what you are doing. And yes, there are good advisors out there, but there are also many bad advisors out there. So I think down to the truth and the reality, I think you're best suited to judge your situation. And if you don't feel comfortable taking that bet, that uncertainty, whether that path really goes up as projected, then you need to buy the smaller house because this is where you feel comfortable. So yeah, you can listen to people left, right, and center, but at the end of the day, you have to feel comfortable. Now, there's another element when buying a house, and that is important also in the context of growing wealth. And this is where this other person could be coming from, because if you buy a bigger house, maybe slightly at the edge of affordability, it might also grow in value in a bigger way than the smaller house. But that has a lot to do with location and features and many other aspects. So you got to be very focused and very concentrated. Where do you buy the house? Real estate also goes in cycle, not always goes up, sometimes comes down, and therefore you need to be buying on a good location where you're going to be sure, or hopefully sure, that it's going to increase in value over time. So it's not only a place to live in, but it's also an element of your wealth creation over time.
Well, if that's the case, how would you go about evaluating a property to assure that it's going to increase in value?
There's no guarantee. Fair question, fair remark. Absolutely. There's no guarantee, but there is a saying when buying properties, and it has 3 rules. It's called location, location, and location. Okay? So that's key, because there are, well located, they're beautiful houses. If they're too remote or next to a highway or whatever, and noise and this and that, and you got to be careful exactly where you're going to be buying, and something which is going to be in demand more or less, sometimes even less, and you might be faced with some price volatility there. But in a general rule, demand will always be there for good location property.
So with savings, how much of your savings should you be putting down on a house? Now, the interest rates are super, super low right now. So realistically, the less you put in, the better, because you're more likely to earn more in the market than you are to be to be paying in the interest. But what if how much would you recommend? Like, if the only way I can afford this house on my salary is if I put a big, the 1/3 is if I put a big chunk down on the deposit, on the down payment rather. So in order for this to be, let's say $2,600 a month, I'm going to have to put in $200,000, which ends up being 33%. Now, does that math add up for you? Or would you say buy a cheaper house?
Tricky question in a sense. When you when you look at that house, and that goes back to my remark about wealth creation, is that part of your, in a way, is that part of your portfolio? And this is the way I would look at it. Or is it just a place to live, right? If it's a pure place to live, stick to the 1/3 rule. If it's also a bit of an investment, then you have to be aware of how much of your investments, of your total wealth, do you want to put in real estate? And when you put it into real estate, how much of that you want to put into one property? Because usually when you look at portfolio allocation, you would use an allocation to property than buying several properties. But I mean, this is like when you're becoming a bit of a professional investor. I think that the audience, which is watching us right now, there's a debate whether they should be buying a house or not, and not whether they should be buying a portfolio of houses, right? If I understand correctly.
Yes.
So I think it always has to be part of your overall wealth portfolfolio, and there it's it's a residual. What can you afford? It has to be affordable. That's most important. There is another thing, and I hope I don't offend anybody. I'm not very religious, but in religion, or in some religions, there are some rules. I think in the Talmud, the Jewish book, they say 1/3 of your money should be in cash, 1/3 should be invested, and 1/3 should be in land. Or even, I think, gold plays a role somewhere also. Or in the Bible, it says, you got to be careful, 7 good years, 7 bad years. So I think this is not, referring to any religion, but it shows you sometimes life goes up and sometimes things are getting bad, right? And then you just want to be prepared for all developments.
So in regards to now investing,
Mm-hmm.
what the hell is the difference between a 401k, a Roth IRA? Where should we be putting our money? Now we have 1/3 of our money into our living. Now, how do we divvy up the other aspects?
To be honest, I'm not very familiar with these different plans in the US, so I wouldn't be able to explain it to you. In Switzerland, don't know whether that's helpful for you guys, but we have the so-called 3-pillar system. And I don't know whether the numbers, the 401k and the IRA, refer to that to a certain extent, but you have the Social Security. system, then you have the pension fund next to it, and then you have private savings. And all three of these pillars are tax privileged. Some of them are compulsory, like the Social Security is compulsory, and also pension fund. It's automatically deducted from your income, and you are a forced saver for your old age. And the third pillar is that the private saving, which you put in the scheme as well, which is locked away, that is also tax deductible, but is at your choice. So these three pillars should make sure that your standard of living, you can maintain your standard of living when you are retiring. But again, I don't know the US system, and I wouldn't be able to give you advice on that.
Gotcha.
But what I can tell that you know, it strikes me when I'm over in the US, when I check into a New York hotel, and then there is an 80-year-old guy who opens the door and collects $1 tips all day long because he cannot afford his old age. You know, that's tragic. And then something's not working with the system, or he had bad luck in his life. I don't know, but that's something which really is a bit of a shock to me, that these people who do you know, extra jobs to make a decent living after they actually will have retired.
I hear you. So one of the other questions that we had coming in, Dieter, was, and I guess this is due to do with not just personally, but also companies. Is it worth taking bank loans while the interest rate is so low, just to have the extra capital, so that you've got some extra leverage? What's your opinion?
Well, extra capital is a question of what are you going to do with the extra capital? Are you going to spend it, like consume it for goods, whatever, or are you going to invest it? But in general, if you take up a loan and use extra capital, and as you said, Alex, you know, it's leverage, and leverage is actually changing the risk profile of your portfolio. You're playing, you can still call it investing, but you're playing with money which doesn't belong to you, right? And I would say, or my advice would be, if you start investing, don't use leverage. Just do it with your own capital and try to grow that capital. If you then have a cushion and you feel more comfortable, and I guess you become a bit more professional investing, you might consider taking up leverage. But you also need to be aware that a number of investment products already have leverage implied into them. It's already included. So you don't need to double up or triple up on leverage. Otherwise, you're really driving with a Ferrari through the financial markets. That goes well as long as everything is good and you're making money, and it can end in tears if it's really bad, because you need to pay back a loan and you just realize losses in the equity market, and you know you're going to be trapped.
So what's the difference between taking leverage for investments and leverage for housing?
Again, taking the rules applicable here in Switzerland, a house has, when you take up a mortgage, you get a so-called loan to value calculation, LTV, loan to value calculation. And in the past, again, you would get roughly 2/3 of the purchasing price as a mortgage. Sometimes they would extend that to 80%. Now, what has happened in the global financial market crisis, which has its sources in a house market bubble, banks would actually give 100% to the purchaser. And it ended up in bad tears, as we all know, right? Because then if market or the housing market goes down just a little bit, the bank is going to be knocking on your door and says, you're going to be paying that extra margin, which the value of the house just lost. So this is, usually they put in the cushion. They only give you 2/3 or 80% of the value. Now the question is, what is the value of the property you're buying? The offer price is not necessarily the value. It's just the price the guy who sells it to you wants, right? Mm-hmm. Doesn't mean that is the real value. But if you have a strong demand, he can lift the price, and you might be even overpaying for your property. While you are overpaying, and this is a decision you take, the bank will stick to their rules and may not give you 80%, might only give you 70 or 60%. So to me, this is a difference, because you have that cushion of 20, 30, 40% between the value of what you're buying and the leverage you're putting in. Now, if you go out and leverage up for buying equities or other investments, equities being the most prominent, when people use leverage, you have a much higher volatility in price, and that could eat up your safety cushion very quickly. And this is why I say, when you use leverage, your risk profile of your overall portfolio increases. That's the difference to the house you own, and you have a loan to value, and that loan has a 30% or whatever cushion to the value itself.
Okay. So does
that make sense?
Yes.
Absolutely.
So if someone were to buy an investment property, that's to you that's a different loan value than someone taking out capital to invest into a company.
To invest into a company, meaning to invest into stocks, into equities, yes. Right?
Yes.
Yeah. It is different. Yes, it is different, because I think that the volatility, the price fluctuations of equities is much bigger than that of properties. Okay. Hence, you might become a forced, or you might ending up in a situation where you become a forced seller much quicker than with a property.
Yeah. Okay. Brooker, next one.
I'm just looking. One of the things that you mentioned a lot, I mean, in terms of, you mentioned it in the budget, and in terms of, other things that we've mentioned about organizing, is you mentioned a lot about sort of the risk tolerance. Now, of course, this is different for each person. I mean, between me and Mike, we have a complete different risk tolerance to everything in life, let alone with finances. Now, I guess also a rule of thumb would be, in typical, the more risk, the potential more reward, of course, if it doesn't cripple you. Within like in the financial world, are there, and I know you mentioned it already a little bit on the previous podcast, but maybe we quickly touch on it again. What are the sort of safer bets that you can go in that are going to sort of generate very low yield, but you're more or less, like, in terms of the risk tolerance is very, very, very small? Is there somewhere that, people should already be looking at in terms of the 30% that they can allocate towards it?
Well, the challenge, I think, would be around finding a decent return these days. We touched on the fact that financing is very cheap. Interest rate levels in general are very cheap across the globe. I mean, Switzerland, very low, even negative. Europe, to a certain extent, very low. And also the US. In the US, I think interest rates are very low. But in general, your defensive element in the portfolio, which gives you a certain yield, a certain performance, without keeping you awake at night, would be starting with fixed income. You're buying a bond portfolio, or you're buying a bond fund where you are generating steady cash flows from the coupons these bonds are paying. And just also maybe going back to the previous podcast, I said, and I mentioned there, the compounding element, the compounding effect on investments is a very strong force. So even if the yield is only 2.5%, which sounds to be almost not worth it. But if you compound that over a very long time horizon, it's still adding up nicely and is building capital over time. There's one element which you got to be careful when investing in fixed income, and that's called inflation. So if your inflation is higher than your bond yield, you're actually losing out on purchasing power, right? So while things are getting more expensive, you are not able to catch up with the price increases by the yield you're generating on your bond portfolio. So that's a tricky one.
Right. And I mean, this isn't part of what the questions that had come in, but say, for example, right now we're in a climate where, I mean, the US is printing a lot of money and we're seeing inflation happening all over the place. I don't think it's something that's really spoken about much, but in terms of job salary prices, they're not really going up as much as the price of all other consumer goods. Would you even say sort of those fixed incomes, are they even the smart thing to even say we've got some people here that have whatever, 30 grand to put away. Would you even be recommending right now that they sort of sit on their money? Because also sitting on your own cash right now probably isn't also the smartest idea if we're looking at, inflation going on. So what would be your kind of, I don't know, your prediction for the future? I know you probably don't want to answer that, but in terms of this way, is the safe bet still to go in this way? Or would you say it's better to be putting it somewhere else or into metals or something like that?
That's not a very difficult one to answer, Alex. And I think I referred to that in the previous podcast. It's all about diversification. Right. You're absolutely right. If you keep the money in cash, it's 100% safe. That's okay. But inflation is going to burn a hole in your pocket. Basically, right. By keeping that money aside and not spending it, which I'm very in favor of. But basically, 5 years down the road, the basket of goods you can afford with that same 30 grand, maybe it's a bit more than because of the interest rate, but that will be less, right? You will be, because goods and services are going up in prices, and you will not be able to catch up with your savings. So even with smaller amounts, you have to do it in a cost-effective way with ETFs and other instruments, which I think I don't want to go into details right now here, but most probably want to, even with smaller amounts, you want to have a diversified portfolio. You would like to have a bit of cash for the rainy day. You would have to have some fixed income, maybe a certain allocation to equities, and the blend of that should help you over the long term to not only beat inflation, but actually grow your wealth and substance over time. But again, it has to be diversified across asset classes and most probably also across geographies. But that should really, over the long term, pay off. Simple rule of thumb, again, if you don't, just looking at the portfolio, have 50% in 40 or 50% in fixed income, and have 40 to 50% in equities, and have 10 to 20% in cash. And you can move on into other asset classes if and when you feel comfortable with it, right? Big theme, hedge funds, things like that. There are different strategies adding to that diversification, commodities, whatever. But let's not make life complicated at this point. Let's just say do a portfolio, part fixed income, part equities, and the part cash aside for a rainy day.
So how would I go about finding a bond?
How would you go? I mean, the prices for bonds are in every newspaper. But if you're very unfamiliar with investing, I think you need to get advice. And if, depending on how much money you want to deploy on buying fixed income, hence a bond, I would strongly suggest to use a bond fund, because the fund is investing in many, many bond issues, rather than you go and buy a General Electric bond. If General Electric business goes really bad, which I do not expect, just as an example, then you are exposed to one company, right? Whereas if you invest into a fund, the fund manager has a whole diversified portfolio, maybe, I don't know, 100, 200, or 300 bonds. So if General Electric being one of them and business is going sour, you still have a lot of other bonds which are doing fine. So I would suggest get yourself advice and then buy a bond fund rather, and a bond or a bond ETF.
And you don't, what about like a bond index?
Yeah, there are bond ETF which you can buy, which are based on the index. Yeah.
Okay. Yeah. All right.
And in terms of, I mean, you know, say like anybody listening here, if this all seems overwhelming to them and they think that they should speak to a financial advisor, are there some like general hints on what you would recommend or where you would recommend people to look for? Because I'm sure there's a lot of scam artists out there as well. So is there some things that you've sort of picked up over the years as to some do's and don'ts in terms of going with financial advice?
You touched on it before. I think the higher the promises, the more skeptical you should be. So don't listen to elevated performance promises. They all come at a price. They all come with risk. And I guess depending on which life cycle and which risk appetite you have, I don't think they might not be suited for you, to put it that way. Going to an established bank and asking for advice usually can be costly. So, you need to negotiate the rate for the advice, or you need to negotiate the commission you pay when you're transacting business. And when you are getting advice, you need to be aware that everybody has its own agenda, has his own ambitions, or has his own goals. Now, if you're speaking to a banker and he's giving you advice, he's most probably going to promote the products of his own bank, right? And he's not going to promote products of other banks or other suppliers of financial products. So that's the tricky part of it. And the best thing, if you can find that, there's no easy advice to give you in that regard. If you have an independent advisor who also is going to charge you something for his advice, because what costs nothing is worth nothing, right? So he also is going to charge you, but at least he's going to browse the market and search the market for the best products. He's going to help you in the way you're constructing your portfolio. You've got to tell him what your ambitions are. You're going to tell him what your goals are with your investments. And on the back of that, he will be structuring a portfolio for you, and he hopefully is going to select good products and investments for you independently, and not being part of an organization which sells products.
Lovely jubbly. Mike, have you got anything else for Dieter?
We're going to have a second episode, because I'm going to re-listen to this and come up with even more questions to go more in detail with. But are you involved in any, we're going to have on a guy that does real estate. And one of the things that he does is he started off with multi-unit housing. And now he's completely renovating. Like he's doing complete gut jobs, renovating them and selling them individually. And I've actually invested with him, and he's finishing up a project right now that he's going to end up selling and do pretty well on it. How do you feel about guys investing in multi-unit housing?
It's an interesting concept. I think the guy if you're successful, and it sounds like you are successful with your investment, and the guy is successful, I think it's also hard work, and it's a question of who are you investing with. Do you trust the guy? Is he a hard worker, or is he just a talker?
Mm-hmm.
But I think there are fantastic things you can do with multi-unit houses. And if you are skilled in, like you said, refurbishing, making it more attractive, you're going to be able to sell them at a higher price. Makes a hell lot of sense, right? But you're going to be teaming up with the right person, like everywhere in life. And like what I just told Alex about that independent advisor, you're going to find this guy, right? And this is important. What is also important, and to a certain extent something to consider with all your investments, but I guess more so even with real estate, is the tax situation. I don't know why, or I don't know how you are going to be taxed on these gains. So whenever you do investments, whether it's fixed income bonds or equities or real estate, you got to be aware what is your net return, because it depends. Certain asset classes, and in particular when it comes down to real estate, if you make a quick buck on it, you might be charged some significant taxes on it, and your net return is going to be impacted by that. So you want to make sure that that this is being taken care of.
So there's a book. I think the book is actually called Buy, Refurbish, Refinance, and Rent. It's like BRRR, or maybe that's just the acronym that they utilize in the book. I've grazed through it briefly. What do you think of the concept of that? So one of the guys that we're having on, that's essentially what they're doing, is they're buying, they refurbish everything, then it gets appraised at a higher value, they refinance, they take the money out, they buy another property, they continue to do it, and they hold on to properties, they fix them up, and then they constantly rent them out. Do you think that that's, I mean, obviously it works in some aspect, but do you think that from where you're sitting, that something like that is worth the returns that you're capable of generating? Would you ever recommend any of your clients do anything like that?
Straightforward? Yes. But this is a combination of the skill set of, first of all, acquiring the right property, having the skill set of refurbishing it stylish because it becomes appealing for people to buy. And then the refinancing part is an element of financial engineering. And to be very honest with you, yes, we have clients investing in funds who do exactly that, and big scale, very big scale, like whole apartment blocks, and then creating a new concept by hopefully get some flagship stores into the ground floor and renting the apartments at a higher price, and all of that. That is a fantastic or a fascinating task to do. But I come back to my remarks before. You want to do that with the right people. These are some skill sets which are not widespread, right? So you want to do it with the right people who buy the right location, hence the right property, have the skill set to refurbish and renovate in a stylish way, and know their math when it comes down to financial engineering. If you find the right people, yes, go ahead.
Bro, Dieter, thank you. Thank you so much. Brooker, you got anything else for him?
No, it's just been spot on. And we need to get you back on again in at least a couple months. I'm sure we're going to have a lot of questions from people, and also let us digest some of this too, and then come back to you, Dieter. But thank you so much for your time as always, mate. It's very much appreciated.
Pleasure coming in. It's pleasure having a chance again to share a bit of my thinking. I'm a bit on the conservative side, but I hope it's still being useful for the audience.
Oh, I'm sure, definitely. Thank you, Dieter.
Thank you, guys. Take care. Bye-bye.
Cheers, mate.